Warren Buffett loves a good dividend stock. What he loves even more, though, is a stock that he can consistently increase its dividend over time. Warren Buffett's investment philosophy revolves around long-term value and sustainable growth. One cornerstone of his strategy involves investing in dividend growth stocks, which offer a unique blend of income and appreciation potential. Here, we'll explore 5 dividend growth stocks that align with Buffett's principles and could be poised for enduring success. Number 1. Verizon Communications. Yield 7.06%. The first highly safe, high-yield dividend stock that's begging to be bought in 2024 is telecom company Verizon Communications. Verizon Communications is an American multinational telecommunications conglomerate offering a wide range of services, including wireless, internet, TV, and phone services. Although Verizon's high growth days are long gone, upgrading its network to handle 5G download speeds provides a healthy and sustainable lift to its bottom line. The company's wireless division generates its juiciest margins from data, and data consumption should continue to climb as consumers upgrade their wireless devices. Additionally, Verizon is beginning to see the payoff from its aggressive spending on mid-band spectrum. The ability to offer at-home 5G broadband has helped Verizon secure more than 400,000 net broadband additions in the past 4 quarters. Broadband might not be the growth driver it once was, but it's the perfect tool to encourage customers to bundle their services. Bundling leads to higher margins and better customer retention. Investors would also be wise to look past the primarily unwarranted concerns regarding lead-clad cables raised in a July report by the Wall Street Journal. Verizon has noted that lead-sheathed cables account for a small percentage of its current network. Further, the U.S. courts would establish any further liability, which could take many years to work its way through. Verizon stock is valued at 8 times forward-year earnings and has a solid floor and reasonable upside. Number 2. Costco. Yield 0.62%. Costco may be considered an honorable mention on this list. Buffett sold Berkshire's stake in the warehouse club in 2020. However, Buffett's right-hand man, Charlie Munger, continued to own about $100 million in shares at the time. Costco pays a regular quarterly dividend that management has increased yearly since it was first declared in 2004. Still, the shares yield less than 1% at today's stock price based on its quarterly dividend. Costco also pays out occasional special dividends to deliver excess cash to shareholders. Those have generally come every 2 or 3 years, with the last special dividend paid at the end of 2020. Notably, Costco has a lot of room to grow its dividend. With its quarterly dividend of $1.02, its payout ratio is just 26% of analysts' earnings expectations for fiscal 2024. At the same time, Costco has a strong cash position. It has more cash than debt on its balance sheet, a rarity for brick-and-mortar retailers. That said, Costco is still committed to putting its cash to work and expanding its footprint. It cost a lot to open a new warehouse. Still, cash from operations is climbing faster than capital expenditures, expanding free cash flow. Investors should expect the trend to continue as Costco manages to get more out of each warehouse over time, while keeping the pace of new openings steady. That should give management plenty of runway to keep giving shareholders substantial yearly dividend raises. Number 3. PennantPark Floating Rate Capital. Yield 10.54%. Safe, high-yield dividend stocks can also be found in the small-cap arena. Business development company PennantPark Floating Rate Capital, which also pays its monthly dividend, is a rock-solid income stock to buy for 2024. It invests in middle-market companies located in the United States. The fund targets companies operating across a broad range of sectors. The company invests in middle-market companies, debt and equity. Middle market generally means unproven micro-cap and small-cap businesses. In PennantPark's case, a sizable percentage of its portfolio is tied to debt securities. The clear advantage of this debt-focused approach can be seen in the yield PennantPark generates. Since most small businesses are unproven, Their access to traditional debt and credit markets may be limited or closed off entirely. As a result, financing deals are often secured at lending rates that are well above average. As of September 30th, PennantPark's weighted average yield on debt investment was an excellent 10.54%. The key to PennantPark's success is that 100% of its $906.3 million debt securities portfolio sports variable rates. The Federal Reserve just undertook its most aggressive rate hiking cycle in 4 decades. These cumulative rate hikes since March 2022 have increased PennantPark's weighted average yield on debt investments by 520 basis points. Furthermore, PennantPark's management team has done a phenomenal job protecting the company's invested assets. The average investment size spanning 131 companies is just $8.1 million, and 99.99% of the company's debt securities are first lien secured. First lien secured debt holders are at the front line for repayment if a borrower seeks bankruptcy protection. Number 4. Pfizer. Yield 6.31%. The fourth safe, high-yielding dividend stock that makes for a genius buy in 2024 is pharmaceutical company Pfizer. Except for a very short period during the Great Recession, Pfizer's existing yield of 6.3% has never been higher. The knock against Pfizer is that its massive bump in sales from COVID-19 vaccines has primarily been backed out of its revenue and profit forecasts. Now that the worst of the pandemic is in the rearview mirror, attention has turned to Pfizer's other drugs and its expansive pipeline. With Pfizer's 2024 guidance failing to impress, shares fell to a 10-year low. Though Pfizer anticipates a 40-cent per share hit to its earnings in the new year due to its now completed $43 billion acquisition of cancer drug developer Seagen, it's essential to recognize that this isn't a recurring loss or expense for the company. The combination of these two businesses will eventually result in recurring cost savings and add billions of dollars in annual revenue for Pfizer. Equally important is the fact that Pfizer non-COVID therapeutics are still growing. Sales for non-COVID products jumped 10% during the third quarter, with Pfizer's special care segment leading the way. If the company's COVID-19 sales bump hadn't occurred, we'd unlikely see such an overreaction to sales and profits returning to their regular upward trajectory. At less than 3 times the forecast sales in 2023 and 2024, Pfizer looks to be quite the bargain for patient income seekers. Number 5. Altria Group. Yield 9.39%. The last of the safest high-yield dividend stocks for 2024 is tobacco juggernaut Altria Group. Altria has raised its payout 58 times over the past 54 years, which makes it a true dividend king. The apparent problem for Altria and its peers is that consumers have wised up about the potential dangers of long-term tobacco use. Since the mid-1960s, adult cigarette smoking rates in the U.S. have fallen from around 42% to just 11.5% as of 2021. A shrinking pool of potential customers has led to modest declines in aggregate cigarette shipments for Altria. However, Altria Group has exceptional pricing power in its corner. Tobacco products contain nicotine, an addictive chemical. The strong desire to continue using tobacco products has allowed Altria to pass along price hikes that often outweigh any decline in cigarette shipments. It also doesn't hurt that premium brand Marlboro accounts for more than 42% of retail cigarette share, which makes raising prices relatively easy. Altria Group is also looking beyond its traditional tobacco lines and shifting its sales toward smokeless products. For instance, it completed the acquisition of electronic vapor company Enjoy Holdings for $2.75 billion in early June. Enjoy has received a half-dozen marketing grant orders, MGOs, from the U.S. Food and Drug Administration for its products and devices. These MGOs grant Enjoy the right to keep its items on retail shelves. The vast majority of e-vapor companies lack MGOs. Like Verizon, Altria Group's forward year price-to-earnings ratio of 8 provides a safe floor with plenty of upside for long-term, income-seeking investors. Warren Buffett's philosophy isn't about quick wins, but about building enduring wealth through quality investments. By adopting a patient buy and hold forever strategy with well-chosen dividend growth stocks, investors can position themselves for enduring financial success. Thanks for watching and see you next time.